What is up? This is the Working Investor. In this video, we're going to cover the new fund from Roundhill called WePay. But I'm not going to talk about what every single YouTuber is talking about, just covering the superficial surface of the fund. In this video, I'm going to go back and peel back the layers of this fund and talk about how Roundhill, I find, is brilliant in their strategy of taking something extremely simple and somewhat dangerous with leverage, and they do many different types of mitigation factors to take something like fire and harness it into energy in a safe manner. Not that it's safe, but I do recognize some of these attributes, and I want to share that with you in my video. As always, nothing here is financial, tax, legal advice, or any sort of advice. This is purely for fun and entertainment purposes and educational purposes only. Please see all my disclaimers. I'm going to briefly just gloss over the fund a little bit in case you don't know anything about this fund, and then we're going to go right into the crux of everything. So Roundhill has a suite of 15 single stock ETFs. You see 16 because the bottom right is WePay. And they launched a few months ago, and all these single stock ETFs are 1.2x leverage on the underlying. They use swap agreements. They don't do any type of option overlay or deriving income. And they basically just give the proceeds of the week to the investor. And it's a leverage product, and that's how I like to look at it. But for those who don't want to have single stock exposure, they came out with WePay, which is basically the fund of funds, universe ETF, whatever they call it. It encompasses the 15 holdings that you saw there, roughly equal weighted. And they're going to waive that extra fund of fund expense ratio until at least September 30th, 2026 per their website, as you can see over here. I would imagine you get paid weekly because it's called weekly pay, WPay. And they just launched a couple days ago. Their AUM is 2.5 million. Their expense ratio, which is passive from the underlyings, is 0.99%. The extra additional expense ratio eventually, whenever they decide to add it on, would be 1.28%. They're giving you a little discount for now. And here you could see roughly equal weighted 6-7%. And they talk about rebalancing monthly. Now, that's something we're going to talk about in the video as well. Now, these are the 5 risk mitigation strategies that I found that it has to try to reduce risk. And we're going to break these down one step at a time. So first of all, let's talk about leverage, right? So leverage is like a dial on your like a light. You can dim it and you can make it more bright. So it's basically like dose dependent. So the more leverage you have, the more risk you take, and of course, potentially the more reward you can derive. But then you can have something called path dependency and volatility decay, which in other words, if you have a sideways chopping market, then you may find yourself much worse off or better off than the underlying because of path dependency and volatility decay. So when you have 3x leverage products, if you're in the wrong market, if you're playing a wrong directional play, then you could find yourself in a world of hurt versus a 1.2x leverage product like WePay, which is very modest. And I believe nowadays the maximum amount of leverage you could put on is 2x leverage. Certain funds were grandfathered in, and then the rules are now 2x leverage. So this is basically just 1/5 of the max leverage that they could put on, 20% more risk. So that's one thing that they did to make it a little bit less dangerous by just having a little bit of a fire, not a big fire. Have a little candle, not a bonfire in your living room. Now let's look at point number 2, the weekly reset. Now this is extremely important, and I don't want you to gloss this over. When it comes to resetting leverage on a leverage fund, there are daily resets. Certain leverage funds are reset daily, like TQQQ. And then there are certain funds that are reset on a weekly basis. And why does this matter for a long-term holder? So the key is relative to the underlier risk. So when I talk about risk, I talk about relative risk to the underlier. Because of course, when you invest in a product that correlates to a certain underlier, you take on the risk of the underlier. Now, relative to the underlier, what's that delta? What's that change in risk, right? So when you have something that resets daily, so if you're playing a directional in and out trade, then you may want to have a reset daily because it resets every day and you got in and out. But if you want to have closer to the behavior of the underlier, you want to and you want to be in that for a longer period of time. Again, not financial advice. The weekly reset is a lot smoother because it only gets reset once a week. So intra week, whatever the price moves, you're kind of moving, you're correlating with the price. Granted you're 20% more leverage, but you're correlating with the price. But if a fund falls one day, and then it falls the second day, and then it falls a third day and fourth day, every day gets reset. It amplifies the losses versus if it falls all these days, but it's only reset once a week, it doesn't amplify the losses. You're on the original leverage amount. You've already loaded up on leverage at the beginning of the week, and you maintain that type of leverage level until the end of the week. And then whenever they reset it, then you load up again. So it gives you less path dependency and volatility decay, especially if you're doing a long-term buy and hold, because most of the prospecti or the prospectuses on these like TQQQ or UPRO, they always tell you this is not intended for a long-term hold, and rightfully so. But there are people that do keep them as a long-term hold that do pretty well with it. I have a whole strategy that I do with it, but that's a whole nother story. But the point is that the weekly reset is something which is something that low-key amazing when it comes to long-term hold. Basically, there are 5 trading days in the week, so it resets 1/5 of the amount of time, and it's 1/5 of the max leverage available of 2x leverage. Well, let's talk about my third point, and my third point, which is pretty apparent to everybody, pretty much, it's the basket of funds. And I'm sure this comes intuitive to everybody. If you invest in one fund, and if one company has an off quarter, then you're kind of in the crapper. But if you have a basket of funds, you're not so pitted down to the return of each quarterly earning of one fund. Of course, there are other risks associated with it. And I wouldn't say it's extremely diversified. It has 15 holdings. It basically has the Mag 7, and it has a little Berkshire Hathaway. It's got some tech defense, which is Palantir. It's got some crypto from Coinbase. It's got some MSTR, AMD. So it has the Mag 7 plus a bunch of other stuff in there. But you can understand and appreciate the basket, which de-risks a lot from a single stock. All right, let's get to my fourth point of rebalancing monthly. So if you just open up their fact sheet, look at point number 3 where it says seamless. So they say WePay or RePray. If it doesn't do very well, I guess it's a RePray. Is rebalanced monthly to equal weight, ensuring consistent exposure to all single stocks within the weekly pay. Now, I really want to make this point apparent. And I'm sure for a lot of my intelligent investors out there, and a lot of my followers are extremely smart and intelligent, what does rebalancing mean, really? So the word rebalance means that when you have a basket of funds, when one fund is doing really well, and it becomes overweighted, like you see here in the Roundel holdings, that some of them are, the weight is a little fat right now. So they would sell high, and they would use the excess to buy whatever's the most beaten down, and they would buy low. So instead of you having to manage those 15 single stock positions to get income and derive income every week, it automatically does it for you. So you have a mechanism built in that sells high and buys low. You have a mechanism that's only moderate leverage. It's weekly reset of leverage. It's diversified, and it constantly, every month, sells high, buys low for you, built in within the fund. So that's another wrapper which mitigates risk. Let's get on to my next point. So the last thing is called risk parity. This is a very important concept for investors to have. And I would argue that the underlyings of the Roundel products have some of it, but I don't think it's the best, but there's some extent of it. It kind of goes with the basket of funds. So what is risk parity? So think about a pair. You're pairing two things up together, and they complement each other. So I like to find funds that they each have their own cycle think about it like the double helix DNA strand. So you have these two squiggly lines on the right and left, these ribbons, and they're both going up, right? For example, but they each have their own dance that they do. They're doing like kind of like a dance together, and they're in locks. Like when one goes one way, one goes the other, and they all have their journey up. But when there's let's say two cyclical type of underliers, when one is on the down cycle, the other is on the up cycle, and then you could constantly take advantage this arbitrage of when one is not doing that great, the other one is overweighted, and that buys low, and vice versa. And you could see that with one of the funds that I am a big fan of. The fund is called GDE, which is basically like Wisdom Tree Efficient Gold Plus Equity Strategy. So it basically stacks gold and S&P, and it's been around for about 3 years, and you can see the total return of GDE is 185%. So gold and the S&P tend to have a very low correlation. I can't even talk today. Correlation coefficient. I just said the same thing twice. Oh my God. So basically, they're not very correlated, but they tend both to go up and to the right. The S&P 500 represents companies that actually produce income. Gold is a commodity that doesn't produce anything, but if you bet on inflation, its price tends to go up and to the right because of inflation. And you can see that gold in this 3-year period of time is up 109%. The S&P is up 65%. But when you combine these together and you take advantage because it rebalances and it has risk parity with rebalancing, it's up 185%. That's crazy. Let me give you my personal example because I'm doing a crazy strategy. I don't want to deviate too much from this video where I do triple leverage NASDAQ, TQQQ, and I have double leverage gold, which is UGL. And basically, I basically keep scalping whenever I have a nominal certain amount that I put in each one. And whenever one pops like $100 to $200 above that amount, I just sell it. And I keep it in cash. And when the other one is beaten down, I put in the other one and vice versa. And it's not a zero-sum game because I actually have derived several $1,000s out of it, and I still have my original equity in these positions, or very close to it. And I've been doing this since around March, April of this year. And the UGL 18% is not the full picture because I did have Shiny, which is a triple leverage gold, but it's an ETN. I did not feel comfortable with the ETN structure. So I sold it. I had a lot of profit. So this 18% is not my total net return on gold. It's just showing you part of the picture. But I'm not trying to brag. I just want to show you the power of leverage with risk parity, with rebalancing. When you stack these things up together, you take highly risky products and you could try to mitigate risk and actually come out on top. Not financial advice. Do not copy me. This is my analysis. Do I like roundhill strategy? I mean, honestly, I think they're the laziest strategy I've ever seen in my life. And they're just good. The strategy is thought out, but they're not doing any crazy options, which I like. They just so simple, just a 1.2x leverage fund of funds, rebalance weekly. But now let's go to this last point, and I don't want to get too far off topic. Let's look again at these holdings. I don't think these are the best risk parity because I could see, they're the Mag 7. You could argue and say that Berkshire Hathaway is a little bit more of a value play versus a growth play. But then you can argue that, Berkshire Hathaway, one of its greatest holdings is Apple, and you already have Apple here. So you're compounding the risk. I understand that they have their own business mechanism. There's a lot more to it. They have a very good balance sheet. But you can also argue the other way. So maybe there is a little bit, maybe not. But then I've spoken to some investors that emphasize that these include the Mag 7. You don't become a trillion-dollar company if you're not a world-class company. And if you're a world-class company, that means you have exposure internationally. Amazon is not just in the US, it's in many countries. Same for Apple, same for all the the Magnificent Seven. You don't become world class. So yes, you can argue and say there's a little bit of a international tilt. You can argue and say these are a lot of them encompass mega caps, so they have a lot more resilience than the small cap companies. You can argue and say that these are the highest by weight of the Nasdaq and S&P 500. So they anyways represent the big moves that you see in there. I hear that, but I would like to see, I don't know, maybe some real estate, maybe some gold, maybe some other stuff in there. Maybe a true international ex-US type of play, like maybe like IDMO, which is a momentum play of the international market, which actually has beaten the S&P 500 many times, which is a big eye-opener for international companies. Another argument you may make is, for example, if you have an ETF that has a certain algorithm, how they choose the underlying, for example, AIPI ETF from Rexshers, where they reconstitute, I think quarterly or something like that, rebalance monthly, reconstitute quarterly, if I'm not mistaken. So they're not biased. If some company starts not doing too well and meeting their criteria, they could dump it and swap it out for something else. But when you have a Roundhill fund of funds or a YieldMax fund of funds, in a way, having this basket funnels more AUM, assets under management, into their single stock underlyings. And if they see truly that one of them is not really performing well and people do not want to have that in the basket, then they may not get rid of it because it's the fund of funds. So it's not, so that's a limitation. Another question you want to ask yourself is, let's take away all the nice bells and whistles. Take away the leverage. Take away the dividends. Look at this as an ETF holding. If there was an ETF that just had these 15 holdings, would this be something that you would find interesting to invest in? And if the answer is yes, and you don't mind leverage, a little bit of leverage, and you don't mind, you like the income, then fine. I can understand the rationale, but just take this mental exercise and ask yourself, is this something that you would like to buy as an ETF, your old meat and potatoes ETF? And don't just get blinded by the bells and whistles. I personally bought a small position in this. Right now, it's sub 1% of my portfolio. I find a lot of these things interesting, stupid simple, but I think they could be effective, and I think it has a use case. Again, that's just me. Anyways, this is the Work Investor over and out. I hope you guys have a wonderful trading week. Be well.